Hello, guys. Welcome again to this Forex YouTube channel where we'll be exposing the truth about trading the Forex market or the financial market. You can take a lot from how to trade the Forex market and apply it to other markets. But be careful, I think every market is unique. The way they are traded and the strategy should be unique in a sense because they are all different in a sense. Just because they all have a chart, a price chart, doesn't mean they should be handled the same way. It would be like trying to use a car to do the work of a bus, or a bus to do the work of a truck. So they are all unique, although they are all driving on the road. So if you watched the last video, I talked a lot about the need to have a trading plan which will help your psychology. And if you don't have a trading plan, you should not trade. Now, some may be wondering, what's the trading plan? How do I have a trading plan? So this video is about the trading plan. What should be in the trading plan and how strict it should be to help you find trading consistency. One, the strategy. The strategy. Now, for the strategy, there are so many kinds of trading strategy. Some uses pure price action, and some uses divergence. Some uses moving average and all that. Whatever you are using, the strategy should be very clear for you to have to be in a plan. What should be clear is this: your entry point. Your entry point. At what point do you enter the price? Should be very clear. Non-negotiable. If it doesn't happen on the chart, you don't enter. After that, your exit point. This is where you get out of the trade. So you should always have an exit. Just before you enter, you already know if price does this and this is where I'm getting out. You must have that in your trading plan. Now, how do you come up with this tool? It's by backtesting your strategy. You must backtest your strategy. You spend hours backtesting your strategy just to be sure that your strategy has an edge in the market. Backtest it. If it's a swing strategy, you should backtest it for the years, because swing strategy you can have maybe like only 2 trades in a month. So that one you should backtest it for years, because you need to test like up to 100, at least more than 100 trades with that same strategy to be sure if you have an edge or not. So that should let you know this when you enter based on that strategy and when you exit. And these 2 things must be in your trading plan. Now, your risk management. Should also be included in your trading plan. If you be risking 1% per trade for your stop loss, it should be there that you are risking 1%, and you should not change it for no reason. If it's 2% you decided you want to be using, use it and don't change it. So not when you are losing, you should be increasing or decreasing. No, stick with your stop loss. And your how much you are risking should not be so high that if you lose up to 20 trades it will blow your account. That is too high. You should have at least up to 50 trades to blow the account, which I think would be almost impossible. So the golden rule, 2%, gives you up to 50 trades. So don't risk more than 2%. But depending on the strategy, some strategy that can get several entries in a day, you can even reduce that 2% to 1% or 0.5%, depending on if you get several trades. Now, for a swing trader or for a day trader, you may have just maybe three trades in a week, or a day trader may have just one trade a day. So for the day trader, I can use 1%. For a swing trader, I can use 2. A position trader can even use up to 4%, like, because they may not have a trade for weeks. And but yeah, you have to be careful with how much you are risking. But you must be in your plan. How much you are risking and how much you are looking your TP. How much you are looking to gain. So let's say you are risking $2. Your take profit should be something like, let's say it should be in your plan. It should be like you are aiming for $3, for example. That's like 1.5, yeah, of your risk. Now, you must always try to hold the trade till you get to your TP. Since it's in your plan, you have to stick with your trading plan by always. Now, for some people, they may be aiming for 10x. You get some people, they may be risking 2 to get $8. That is not 10x. That's I think this is 4. This is 4x if you are risking 2 to get 8. Now, if you are risking 2 to get 8, you need to also understand as you are writing your plan that there will be times where price will go and give you up to $5. You'll be seeing the $5 floating profit, but it can also return to take you out in your maybe in your exit point or in your stop loss or in break even. It will happen. So you have to prepare your mindset for it to happen. Because else once it happens, if you don't prepare yourself, once it happens and you are trading live, you get angry. You try to want to jump into a trade to recover that loss that just made you angry. You feel you can do it, and then that is the beginning of the problem for you. So yeah, you should have this in your plan. Now there's also something known as sort of helping you manage your emotions. Engine emotions. It's something like if you lose up to 2 trades in a day, maybe you are a scalper and you have 3 trades, you can say, okay, when I lose up to 2 trades in a day or 3 trades in a day, I'm done for that day. I don't care if my setup shows up again, I'm done for that day, I'll come the next day. You need to have something like that because there are some days that will, if you keep going, it will mess with your trading psychology and you start you start doing things that is outside your trading plan, and your plan is meant to save you in the market because the market doesn't care. You have to protect your capital at all costs. So things like that, you can say, okay, 2 losing trades in a day, and I'm done. I'm done. 2 losing trades, you need to have something like that. And for some people, you can say, okay, if in a month I make up to 10%, I'm done. I'm not trading anymore. I've reached my target. You can have that if you want. Although I'm not a fan of that because some months can be really good. As long as you are sticking to your plan, why should you cap your upside? You get, because some months can be really bad and some months can be really good. That's the thing about trading, is that it's not a straight line. So there'll be wins, there'll be losses, but then the wins will be more than the losses. As in the returns from the wins should be more than the losses. And if you're able to keep the losses small, keep the wins big, you should be doing well. So yeah, it's basically if you are starting to make your trading plan, you must put all this into consideration. It's very important, very important. And when you make a trading plan, stick to it at all costs, even if it will be hard sometimes because you may be following your plan and maybe you're in a trading group. Yeah, talking about a trading group, I have a Facebook trading group where traders share their trade setups and discussion tips and all that. I'll put the link in the description of this video so that if you need a group where you can be with other traders, chill and just talk, have fun, laugh at each other, share good tips, and also see live setups of trades before it moves being posted, and just maybe compare it with yours and see you can join. Although You should not let anyone's trading setup influence yours because everyone is using different trading strategy. But it would be good for you to be in a community like that. So you can be in a community like that and you see some people making money and you're following your rules and you're not making money. You'll be tempted to maybe copy something they are doing or try to replicate it with it, make them something your strategy to tweak it. You should not do that. You should not do that. This is the hard part about sticking with a strategy. It is very hard sticking with a strategy. At least try to stick with it at least 3 months. Win or lose. 3 months. You've tested it, you've back tested it. You know it has an edge. So try to stick with it at least 3 months. Just let it play out. That's why you should risk maybe very small during this time. You can use a cent account. You can use a cent account is if you deposit $10, to be showing as $1,000. So you can sort of break it down and be putting $1 in a trade or even less. Just to see it play out. I say a cent account because I want you to use a live account. You cannot do this on a demo. On a demo, it's very easy to follow your rules. There's no money. But on a live account, even if it's a $10 account, there are sometimes you may pay after 2 weeks you may think, okay, uh, let me increase it. I can turn this. Maybe you raise the money from $10 to $15. You may think, now let me just make this $15 $45, and then you use crazy risk outside your plan. The temptation will come on the live account, only on the live account. So you should do it on a live account. Try to stick with it 3 months, and you will be way ahead of many traders, even way ahead of me. I'm still in the process of completing my own months on this. It's not easy, I can tell you that. It's with testing in many ways. But yeah, this is what you need to do to become consistently profitable. Because the goal is not to be profitable. Anybody can be profitable. Consistently profitable. Yeah, this is what you need to do. All right, guys. See you in the next one.